Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific on Friday, October 13th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's talk about that. Tonight, it's all about the battle lines being drawn across the various fronts, from the G20's global crypto map to the IRS's tax controversy, from legal entangles in the stablecoin arena to developments in central bank digital currencies. We're diving deep into the conflict shaping the crypto world, so buckle up, it's gonna be a ride. The G20 finance ministers and central bank governors adopted a roadmap. This roadmap was proposed in a synthesis paper by the International Monetary Fund and the Financial Stability Board. The aim? To regulate crypto assets on a global scale. The roadmap outlines a comprehensive strategy for international crypto policies. It focuses on 5 core areas: policy frameworks, global coordination, information exchange, data gaps, and outreach beyond G20 jurisdictions. This was finalized in Marrakesh under the Indian presidency, and their message was clear. Swift and coordinated implementation is needed. Now, why should you care? This roadmap is a blueprint for the future of crypto, at least their version. It will affect how governments and financial institutions interact with crypto exchanges. And let's not forget, this is the G20 we're talking about, the group of people who represent the world's largest economies. The synthesis paper also emphasizes the impacts of crypto assets on emerging markets and developing economies. The G20 plans to request systematic and periodic reports from the IMF and FSB. They're keeping tabs on the implementation, which means they're serious about this. The G20 endorsed the standards set by the Financial Action Task Force concerning crypto assets. This shows a unified front in tackling issues like money laundering and financial stability. But let's read between the lines a little bit here. When governments and international organizations start talking about things like standards and regulations, they really mean control. This move by the G20 is a significant step in the global governance of crypto assets. The adoption of a roadmap, backed by powerhouses like the IMF and the FSB, signals a shift towards a more regulated crypto environment. While the G20's roadmap aims to address the challenges associated with the crypto market, it also raises concerns. The focus on policy frameworks and global coordination could lead to a stifling of the very decentralization that makes crypto unique. The roadmap's emphasis on extending efforts beyond G20 jurisdictions is particularly noteworthy. It suggests that the G20 is aiming for a global reach in its regulatory efforts, which could have far-reaching implications for the crypto markets worldwide. The call for periodic reports from the IMF and FSB also indicates a long-term commitment towards monitoring and potentially controlling the crypto space. The G20's move could be seen as an attempt to bring crypto assets under the umbrella of global governance, which has its pros and cons. On the one hand, it might bring more legitimacy to crypto assets. On the other, it could undermine the principles of decentralization and financial freedom. The endorsement of FATF standards is another point of contention. While these standards aim to prevent illegal activities like money laundering, they also impose stringent controls that could inhibit innovation and financial freedom. The G20's adoption of a crypto asset roadmap is a pivotal moment in the ongoing saga of crypto regulation. It reflects a growing consensus among global powers to bring crypto assets into the fold of regulated financial markets. However, the extent to which this will benefit or hinder the crypto community remains to be seen. Alright, you've heard the G20's grand plans for crypto regulation. But while they're busy drawing up roadmaps, Uncle Sam is facing resistance. Let's pivot from global to domestic. Next, we're dissecting the IRS and its battle with Coinbase. Don't forget to hit that subscribe button to stay ahead of the curve. And this is our cover story for tonight, although we kinda started this story last night. You'll see what I mean in a minute. Coinbase unleashed a torrent of criticism against the IRS's recent proposal for crypto taxation. The IRS aims to define crypto brokers and set guidelines for tax payments. But Coinbase isn't having it. The VP for Tax for Coinbase Global called the proposal an unprecedented, unchecked, and unlimited tracking on the daily lives of Americans. Coinbase argues that the IRS's proposal would impose a burdensome set of new reporting requirements. These rules would degrade the very taxpayer services that IRS aims to improve. The Blockchain Association also warned that these provisions could annihilate the industry in the US. The IRS, however, has its own concerns. They claim the crypto industry is dragging down tax revenues. A recent tax gap estimate by the IRS highlighted crypto as part of a growing problem. The Treasury Department's nearly 300-page proposed rule aims to address this by setting out reporting obligations for centralized crypto exchanges, payment processors, and even some decentralized exchanges. And as we were talking about last night, Democratic senators, led by Elizabeth Warren, advised the IRS to ignore industry complaints. They want the rules to go into effect as soon as possible, arguing that delays would cost the federal government billions in tax revenue. Coinbase, however, asked the IRS to rewrite the proposal to limit compliance requirements to parties that directly handle transactions in digital assets. Coinbase listed 6 obligations to the IRS's proposal: lack of parity with financial services, duplicative and burdensome reporting, invasion of privacy, violation of tech neutrality, unrealistic compliance timeline, and a missed opportunity to leverage blockchain for taxpayer compliance. They argue that the proposal's overbreadth will make it harder for the IRS to enforce tax laws on crypto transactions involving U.S. persons. The crypto exchange called for a more targeted approach, one that would streamline reporting requirements without compromising tax compliance. The Blockchain Association has also warned that stringent regulations could stifle innovation and growth within the industry. The IRS will continue to accept public comments until October 30th, and a public hearing has been scheduled for November 7th. Coinbase intends to provide more detailed observations and technical comments in an additional letter. So the battle lines are drawn, and the crypto community is watching closely. Will the IRS heed Coinbase's warnings, or will they push forward with a proposal that could stifle the very innovation that they claim to support? The clock is ticking. We just laid out the IRS's tax controversy. From one legal minefield to another, up next is a high-stakes showdown involving a stablecoin and Wall Street bigwigs. Keep listening and make sure to activate those notifications to stay informed. Terraform Labs, the company behind the Terra USD stablecoin, is in a legal tangle with Citadel Securities. The crux of the matter? Terraform alleges that Citadel played a role in the depegging of the UST stablecoin back in May of 2022. The asset crashed from $1 to just 2 cents. Not what you want to see in a stablecoin. Terraform has filed a motion in the U.S. District Court for the Southern District of Florida. The motion aims to compel Citadel to provide documents related to its trading activities during that tumultuous period. Now, why is this important? Because Terraform is also fighting a lawsuit filed by the U.S. Securities Exchange Commission. The SEC accuses Terraform and its founder, Do Kwon, of orchestrating a multi-billion-dollar crypto assets securities fraud. Now, let's dig a bit deeper. Terraform isn't just throwing accusations around. They claim to have, quote, publicly available evidence suggesting that Ken Griffin, the head of Citadel, intended to short the UST stablecoin around the time of its depegging. Now, this evidence includes a screenshot from a Discord chat where Griffin allegedly discussed his plans. Citadel, for its part, denies any involvement. They've stated that they have no role in the depegging event and do not trade in UST. They've dismissed Terraform's motion as frivolous and based on false social media posts. So why do we care about this? If Terraform's allegations hold water, Citadel could be implicated in the scheme that knocked more than $80 billion off the sector's total value. This event also played a role in the bankruptcy of several other prominent players in the crypto space, including Three Arrows Capital and Celsius Network. This is a battle that could have far-reaching implications for the crypto industry. If Citadel is found to have intentionally destabilized UST, it would be a damning indictment of traditional financial market players meddling in the crypto space. On the flip side, if Terraform's allegations are proven false, it could severely damage their credibility in standing in the crypto community. In either case, the outcome of this legal battle will be a watershed moment for crypto, setting precedents that could influence how traditional financial market players interact with the burgeoning crypto space. And let's not forget, the SEC is watching closely, ready to pounce with regulations that could either stifle innovation or bring much-needed stability. So as Terraform and Citadel lock horns in court, the crypto world watches with bated breath, aware that the outcome could reshape the landscape in ways that we can't fully comprehend. Legal battles aren't confined to the US shores. From legal disputes to geopolitical maneuvers, next we're flying to China. The Chinese are making moves in the central bank digital currency arena. And if you're liking what you hear, give us a thumbs up. China's central bank, the People's Bank of China, is making strides in the development of its central bank digital currency. But what's catching attention is their focus on security and abuse prevention. One former PBOC governor emphasized the need for robust security measures. He pointed out that the cost of misuse decreases as technology becomes more convenient. He also mentioned that the CBDC could be used for illicit activities like money laundering and arms trading, necessitating strong preventative measures. Now, let's talk about the Shenzhen Industrial Park. It's the first of its kind, dedicated solely to the development of the digital yuan. The park is offering incentives like free rent for up to 3 years and financial aid to commercial banks and startups. The aim? To boost the digital yuan ecosystem, focusing on payment solutions, smart contracts, and hard wallets. Despite these advancements, the adoption rate is still considered sluggish. As of 2022, 261 million digital yuan wallets were created. But by 2023, only 36 million wallets were opened in Shenzhen alone. Transactions have hit 1.8 trillion yuan, but that's just 0.16% of China's monetary base, their market cap. That's a lot of room for growth. Now, let's delve into the programmable features of the digital yuan. Lu Lei, Deputy Administrator of the State Administration of Foreign Exchange, highlighted these features. They could expand the role of CBDCs beyond just cash in circulation to include various forms of deposits and savings. These programmable settings can be adjusted to have expiration dates or usage restrictions, offering a new layer of control. Big surprise. Cross-border transactions are also on China's radar. Last year, Chinese state-owned banks participated in a trial focused on cross-border transactions. The digital yuan is already being tested for cross-border payments in Hong Kong. As we reported the other night, it's already been integrated into Hong Kong's faster payment system. So what's the big picture? China is aggressively pushing its CBDC, not just as a form of digital money, but as a tool for broader financial and policy objectives. While the rest of the world watches, China is setting the stage for a financial ecosystem that's more controlled. The question remains, can a centralized digital currency ever gain the trust of a global audience? Especially an audience that's well aware of government controls built into the digital yuan. Only time will tell. From China's state-led initiatives to regulatory crackdowns back home, the drama doesn't stop. Coming up is the CFTC's bout with Voyager. It's a tale of caution in the world of crypto finance. If you're concerned about surveillance in the future of money, drop us a comment below. Former Voyager Digital CEO Steve Ehrlich is in hot water. Now, we were just talking about the possibility of this happening the other night. The CFTC and the FTC filed lawsuits against him and his company. The charges? Fraud and making false claims about FDIC insurance on customer funds. The CFTC accuses Ehrlich of defrauding consumers. He allegedly misled them about the company's strength and operated without proper registrations. The FTC adds that he lied about FDIC protections. Now that's a big deal because FDIC insurance is the cornerstone of trust in the financial world. Lying about it is a cardinal sin. But it gets worse. The CFTC claims that Voyager took, quote, shockingly reckless risks with customer assets. This led to the company's bankruptcy and massive customer losses. CFTC Enforcement Director Ian McGinley didn't mince words. He said Ehrlich and Voyager lied to customers while taking these risks. Now, not everyone at the CFTC agrees with the charges. Commissioner Caroline Pham argues that the CFTC's stance on what constitutes a commodity pool operator is flawed. She says it's an overreach of their authority. Now, the CFTC isn't pulling punches either. They banned Voyager from handling customer assets. They also slapped him with a $1.65 billion judgment. This is to allow Voyager to continue its liquidation process to pay back customers. So what led to this downfall? According to the CFTC, from February to July 2022, Ehrlich and Voyager engaged in a scheme. They misrepresented the safety and financial health of their platform. They promised high-yield returns, sometimes as much as 12%. To generate this income, they pooled customer funds and transferred billions to high-risk third parties. CFTC Commissioner Kristen Johnson had harsh words for Voyager. She said the company ignored warning signs and failed in its due diligence. She called Voyager, quote, no better than a house of cards. This is a reminder that regulatory oversight in the crypto space is not just necessary, it's crucial for protecting consumers. And for those who think they can skirt the law, well, the CFTC and the FTC shows what happens when you try. We've looked at regulatory pitfalls, but not all hazards are from watchdogs. Our final segment uncovers a fraudulent scheme that's one of a kind. Got an opinion? Let's hear it. In a landmark case, the Department of Justice charged Peter Camblin, the former CEO of Systematic Alpha Management, with conspiracy to commit commodities fraud. The charge centers around a, quote, cherry-picking scheme involving crypto futures contracts. This is a first-of-its-kind case, and Camblin faces up to 5 years in prison if he's convicted. The scheme ran from January 2019 to November 2021. Camblin fraudulently allocated profits and losses from futures trades. He did this to benefit his own accounts at the expense of his clients. Cherry picking refers to executing trades without assigning them to a specific account. The trader waits to see if the trade is profitable or incurs losses before making the allocation. While he was charged by the US DOJ, Camblin's actions had international ramifications. He defrauded investors not just in the United States, but also abroad. The proceeds from this scheme funded his lavish lifestyle, including rent for a beachfront apartment. The money was also transferred to foreign accounts controlled in Belarus and Dominica. The Commodity Futures Trading Commission previously hit Camblin with civil charges. The scheme generated at least $1.45 million in total trading profits for Camblin and his firm. The money was used for personal expenses and was also transferred to foreign bank accounts controlled by a co-conspirator. This case is an example of how centralized power can be abused, even in the crypto space. It's a wake-up call for investors who think that crypto assets are immune to traditional forms of financial fraud. The government's involvement in this case may be seen as a necessary evil to some, but it also highlights the need for decentralized systems that can prevent such abuses from occurring in the first place. The Assistant Inspector General for Investigations is Simone Richmond. He emphasized the importance of holding Camblin accountable. He said that the plea recognizes the need to hold the defendant accountable for misleading and defrauding investors. So what does this mean for the crypto community? Fraud exists everywhere, even in spaces we consider to be revolutionary and disruptive. It's also a signal that regulatory bodies will not hesitate to step in, further fueling the debate on the role of centralized authorities in a decentralized world. So, what happened? The G20 finance ministers have adopted an IMF and FSB roadmap to regulate crypto. Aimed at a level playing field, this move signals a shift towards more organized governance, but comes with concerns about stifling innovation and financial freedom. Coinbase clashed with the IRS over a new crypto tax proposal, calling it an unprecedented invasion of privacy. The IRS is undeterred, citing tax revenue losses, while Coinbase warns of annihilating the crypto industry. Terraform Labs is in a legal battle with Citadel Securities over the depegging of its UST stablecoin. Accusations are flying, implicating Citadel in market manipulation, with the SEC looking on. China continues to advance its central bank digital currency, focusing on security and abuse prevention. Despite incentives, adoption remains low, raising questions about the digital yuan's global acceptance. Voyager Digital's former CEO faces lawsuits from both the CFTC and the FTC for fraud and false claims about FDIC insurance. Regulatory agencies are cracking down hard, reminding us of the need for caution and due diligence. In a first-of-its-kind case, Peter Camblin, the former CEO of Systematic Alpha Management, is charged with a cherry-picking scheme in crypto futures contracts. This serves as a warning that fraud is not exclusive to traditional financial systems. The overarching theme tonight centers around the conflicts and confrontations shaping the crypto landscape. Be it G20's global regulations or the IRS's domestic tax plans, there's a tug-of-war between control and innovation. Meanwhile, legal battles like Terraform versus Citadel show the vulnerability of the crypto market to both internal and external manipulation. These confrontations are symptomatic of a broader struggle between centralized control and decentralized innovation. Tonight, it's evident that we're in a pivotal phase. The outcomes of these battles will either set the stage for a crypto system that thrives on innovation and financial freedom, or pave the way for a more regulated, controlled environment. What's certain is that the lines are drawn, and the crypto world waits in anticipation for what comes next. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.